Yeah, so for once, the bond guy is actually popular and people want to talk to me. The only surprise is that people are actually surprised, right? We're plumbing 50-year lows in terms of unemployment, in terms of jobless claims of the labor market. So this move has been kind of expected, right? We've been talking about it for several months now. There's been a big disconnect between the Fed and the market, where the market was saying one hike for 2019 and the Fed was saying three. Whenever you have a disconnect like that, you should expect volatility and you have to expect that discount to narrow. So again, Powell and the committee have been talking for a long time that rate hikes are coming, and the market is finally starting to believe that, and the market is starting to capitulate to the Fed.
But what you're saying is kind of the opposite view of what we've seen play out in equities to this point. If this is happening because we have a great economy and because unemployment is at such low levels, people should be a little more sanguine about it. People should be thinking, okay, it's happening for all the right reasons, right?
You would think people would think it's happening for the right reasons. I would say, obviously, there are different sectors that are going to react different ways to how interest rates are moving up, and the pace of it also has a change on markets. It changes sentiment a little bit. So a move of this magnitude will cause a little bit additional volatility. You do see historically, as you look at the rate hike cycles, volatility does return to normal levels as you get later into the rate hike cycle, and that's what we're seeing now. These last couple hikes are creating more volatility in the equity market.
Although I would say that's the one thing where this is different from all other times. Like, returning to these levels after the Fed has been so active, after it's been spoon-feeding the markets what to think on these things, this may be where you say this time could be a little bit different just because what we're coming out of is different than what we've seen in recent memory.
So I certainly think the combination of higher rates and the reduction in quantitative easing will be something new for the markets to digest. That being said, there's nothing new under the sun. The Fed has basically one way it can impact the markets, that's to increase the monetary supply. So Powell will be patient, we believe. Right, he has highlighted that the risks are two-sided. As you're pointing out, this is a new cycle. We have not seen this before. Absolutely correct. They're going to go meeting by meeting. They're going to look at the data, and they are going to cautiously want to extend this recovery. They have no sense that they want to restrain it at this point. They're not worried about inflation. So I think spoon-feeding the markets was the way you put it, not exactly the way I put it. But I think they will be very cautious to let this recovery continue because there are broad swathes of people in the economy that still need to do better. So he's going to be very careful the next year.
Mark, all other markets are kind of keying off this at this point. You look at equities, you look at currencies, and how would you be telling people to interpret all of this right now?
Well, I think that the real driver for the dollar is this divergence. As U.S. interest rates are rising, Europe cannot do so. And here's a good thing that happened today, that illustrates this point. Germany reported the third consecutive decline in industrial production.
Yeah.
Europe wants to exit their extraordinary policies. They'll stop buying their assets, but they're very far away from raising interest rates. By the time Europe's able to raise interest rates once, at the end of next summer, the Fed would have gone 3 or 4 times possibly.
So what we've seen in currency markets to this point doesn't sound like it's necessarily factored all of that in. I'm still surprised at how the dollar's not even stronger than it is.
Yeah, no, that sort of puzzles me as well, but I think the market is pricing in 3 rate hikes between now and the end of next year, and the Fed says there'll probably be 4. And so I think there still is some adjustment for the dollar to make up, and as well as other problems in the world, not only China, Germany, but Italy's blowing up as well with 20 basis point increase in interest rates. So I think the U.S. still looks like the best play in town.
And that's what you're telling investors on a regular basis?
On a regular basis. I do think that the dollar is a bit stretched. We could see a bit of a pullback, maybe led by the Aussie, but in general, the dollar's trend is higher.
The Chinese every day reset the renminbi against a basket of currencies, but we always look at it compared to the dollar.
Sure.
What do you think of the move they made this morning where they let it weaken? They didn't go to 7, but some people were wondering if they would. How closely do you pay attention to that? Doesn't matter. Yeah,
it does matter. I think that the cut in reserve requirements over the weekend was basically a signal, that coupled with the decline in the net export orders from the PMIs, all pointing to China allowing a weaker currency. So I think we'll see it at 7 in the next couple of weeks.
Is the market ready for that?
I think that the Chinese market is more or less isolated because it's really dominated by retail investors compared to, say, the U.S. stock market dominated by international or fund managers, really. And so I think that what happens in China doesn't necessarily have to spill over on everybody else.
So the previous time when we saw them weaken the currency and the markets here went, a little haywire, not going to happen this
Not going to happen to the extent that it did before. The Chinese stock market's been down most of this year. I think the currency's been weakening most of this year, like emerging markets. But I think there's hotter spots in emerging markets like South Africa today, India, hot spots that are sort of eclipsing the Chinese sun.
Hey, John, oil has been a little unique because it's got the sanctions with Iran that's really been the driving factor in where oil prices have been headed. We did see 4-year highs hit last week for WTI.
Right. Nearly $77.
Right. We're down this morning by about 1 1/3%. So has all of that been baked in and now you're going to see a little bit of a pullback?
Well, I think what both of these gentlemen have been talking about is the sort of newer factor for the oil price dynamic now, that demand is now a concern. To the extent you want to hike interest rates to cool an economy that's maybe getting too hot, that takes down demand. This rise in the dollar is crushing emerging markets, crushing the demand centers, the demand growth centers for oil. We have seen now Russia and the Saudis actually step up. This was an issue I was concerned about, whether or not the Saudis would come through with more oil. It appears they are, and they may be doing it just as demand is starting to ebb a bit, which could tip things back to the downside for oil for a while.
So you're talking about demand just on the global picture, not here in the United States.
Mostly the global picture, but to the extent that these interest rates here start to work against the economy, domestically, that is the intent. We'll see it here too.
You think if we're really looking at 3 rate hikes in the next year, that's going to be a situation where we say, oh no, it's going to crush the economy?
I'm not saying crush the economy, but certainly the stock market doesn't appear to be liking it, the prospects of it very much. And it's going to start to hurt consumers on the edges with higher interest rates for home equity loans and all the rest of it. You see the airlines are already hurting from the higher fuel prices. So, it just starts to eat away at the edges. It starts to eat away at the incremental demand that really sets the price.
What's the price that's a real problem in your mind?
For consumers at the pump,
yeah,
really $4 a gallon for gasoline. That's where your SUV costs you about $100 to fill it up. But I'll tell you, people at the heating oil tank, the airlines are already, and the truckers, $3.40. They're already at $3.40 a gallon for diesel fuel.